Oh man, so a big day in the markets today. We've got the official federal Jerome Powell speech, and we're looking forward to it. We've had the PCE data just over an hour ago. That came in positive, okay? So we're going to recap the PCE data. We've then got about 15 minutes or so before Jerome Powell is scheduled to give his speech. Let me just switch over just to make sure you guys can hear the audio. Can you guys let me know if you can hear the audio when I switch over to it?
Complex problems that come to you.
Let me know in the comments if you can hear that audio. If you can't, we'll make sure we get that fixed before Jerome Powell comes on.
Resolving tend to be highly complex and nettlesome. So your ability to solve those complex.
Good stuff. We'll pause that. We'll go straight now into the charts. And what I've done is I've gone ahead and set up. We've got Bitcoin on the left-hand side, 5-minute chart, and we've got the S&P here on the right-hand side. We want to see how this affects both the markets. I've also got the Bitcoin chart here on the hourly. You can see a little bit of volatility over the last 2 hours here. It looked like we were going to break down, right? Look at that perfect bear trap here, right? The shorters had shorted from the bottom, waiting for the breakdown of this bear flag, and then the longs came in. Whole bunch of volatility. Traders playing games. So if you're not experienced, guys, be very, very careful out there. If you know what you're doing, then feel free to have some fun trading. Now, what we need to look at is the PCE data. Good to see everybody in here. I'm just reading the chat here with you guys. Let's see who we've got in here. Doug, good to see you. Barney, good to see you. Easy Life Gadgets. BGM, good to see you. Pihan, good to see you guys. Caffeinated, good to see you. Kanani, Casey, Stu, a lot of familiar faces in here, guys. Good to see you all. Digital D, good to see you. What's up? Nelson's here. Dan's in here. Dinesh is in here. Shout out to you guys. If you have any questions, feel free to put it in the questions, and I'll try to get to those questions. But in essence, what we're looking out for is, does Jerome Powell come in hawkish or does he come in dovish? Now, it's crazy how much weight the market is placing on Jerome Powell right now. It's like they're being a little baby, like I said in my video earlier today. They're just one direction. It's like in July, he was dovish, and then the market rallied, and then they're like, oh, Jerome Powell, are we okay to carry on rallying? Like, why can't you just be grown-ups? You can see the data yourself. Why do you need to rely on Jerome Powell? So interesting to see how Jerome Powell comes out. Look, the data's getting better, right? We saw CPI earlier this month got better. PCE inflation, which is the Fed's preferred measure of inflation, has also notched down. Now, nothing to get too carried away with, because we haven't seen sustained pressure to the downside. We've just notched down. We've notched down before and then increased again, right, to create a higher on inflation. So we want to see it come down. I think that's going to be Jerome Powell's message as well, is that let's be patient, let's see continued downturn, and then we can start thinking about a U-turn. So it'll be interesting to see what he says. We'll cover that off live today, but good to see that other macro factors are coming down. The only thing that isn't softening is the labor market. Labor market's still really tight, and I think Jerome Powell will be leaning on that to say, look, labor market's still good. GDP wasn't that bad, right? They revised it to minus 0.6. It wasn't like we're in a heavy deep recession. So he could claim I can still be aggressive with my interest rates hike. Andy, good to see you, buddy, saying I'm looking sharp. Oh, thank you. I got a haircut just for Jerome Powell. He's the only person I would get a haircut for. Mohammed, good to see you. Interesting dividends. Good to see you here, Billy. Good to see you, Edmund. Will Powell emerge and see his shadow? Yeah, perhaps. Good to see all of you guys in here. 94 of you at the moment. Can you guys all smash up the like for me? Really appreciate that. If you can smash up the like, it will share this stream with more people. We are just under 13 minutes away from Jerome Powell. We'll keep that up. Let's listen into Bloomberg to see what they have to say in the lead up. Actually, they're on some adverts right now, so we'll let them crack on. We'll take a look at this chart, and what we're looking from here from a technical perspective is we want to see, do we get the breakout from this flag? Remember, good news is him coming across dovish. If he comes across dovish, what we will see is that the market will price in more of a 50 basis point. This bottom one, that percentage should increase, because more of the market should price in 50 basis points. If he comes out hawkish, we'll see the opposite. We'll see this increase, so more people will price in 75 basis points. In fact, let's refresh to see if that changed since the last time I refreshed. Oh, look at that. Look at that, guys. Proper yo-yoing. The traders are proper playing games right now, and this is why you have to be careful. So now, going into this meeting, it was flipped the other way, right? It was 60% of people had priced in 75 basis points, and now when we're literally just minutes away from Jerome Powell talking, what they've done is they've gone ahead and priced in 61% have priced in 50 basis points. Right? So now the market is setting itself up for a little hammer to the downside, because if he comes across hawkish now and the market's priced in that he's being dovish, this means he's being dovish, right? The more people price this in, think he's going to be dovish, we could see a horrible thing to the downside. So we want to keep an eye on this bear flag. If we break to the downside, it's not going to look pretty. Remember, if you take your measured move from here to here and you apply that to the breakdown, then you have a price target which comes back down towards about 19,000. Yep, 19,000 there as your technical price target from this bear flag, okay? So that's something we want to watch out for here on the downside. In terms of positive news, if he comes across dovish, then hopefully we can use that as a catalyst to hold the 22,000 level. Can we get above the channel, hold 22,000, and then work our way back up to these kind of levels back at 23,000? Because we fell quite quickly on that Friday, if you remember. So we should be able to recover that just as quickly to the upside. So that's what we'll be looking out for here on the charts. And if you appreciate this blend, guys, between macros, technicals, fundamentals, all in one place, and making sure you guys get the news as and when it matters, please hit up the like button, guys. Don't forget to subscribe. That really does support me if you hit up that like button and share this video to get this video out there. Because you know what YouTube's like. They just want to share the Moon Boy videos. But we've got to show the new investors who are born into crypto that this is all about macroeconomics. You have to listen to Jerome Powell. If you really care about your portfolio, you have to care about Jerome Powell. And anybody with real money in the markets right now is watching and listening to this right now. Vincenzo, good to see you, buddy. Doug, smash the like button. Yes. Hartik, appreciate you, buddy. Who else we got in here? Naweed, good to see you. Floating high. Mark Murphy, good to see you, buddy. Hope you're well. Caffeinated says, I still think he will be hawkish. No, you're asking me a question. Yes, I still think he's going to be hawkish. Look, it's hard because a lot of the data is showing better, but I think what he can say is things along the lines of one set of data is not enough, right? I think that's the message he needs to drive home is you've had one CPI reading and you've had one PCE reading, and that's not enough for me to U-turn on my policy. Right? I need to crack on until I've seen sustained downturns in these figures, but it's a good start. And he should celebrate the fact that it was a good start, but markets won't take that too much into account. It's only if he gives us a clue of pausing interest rates or reducing from 75 basis points that markets will then rally. So that's what we're looking out for here on the markets, okay? So we're looking forward to that. We've got just over 10 minutes to go. Let's see what Bloomberg's saying. Oh, we got Gary Gensler.
Kennedy, bipartisan, who led that effort, to say that there was a clock, that there was going to be a 3-year clock. If China didn't comply, all 200 of these companies are going to have to leave our U.S. capital markets. And then the SEC and this other organization, the PCOB, in the last year and a half have been really effectuating the will of Congress. And I think when we Americans speak with one, bipartisan voice, unanimous voice from Congress, from the SEC.
We'll let him crack on there. Let's just take a look at fear and greed index, guys. We've got 27 here on the fear and greed index, okay? Just to recap what we've had GDP revised slightly up, right? So minus 0.9 to minus 0.6. We've now had the PCE come down. Previously, we had the CPI reading come down a couple of weeks ago. Labor market still seems a bit strong. These are the things we're looking out for now, okay? So these are the things on our mind. We need to keep an eye on this Fed rate monitor tool because between now and September the 21st, when the next FOMC meeting is, this is going to set the tone. Can we rally between now and then? Is Jerome Powell going to give the market permission to rally? That's the key right now, okay? Now, let's also take a look at the pre-market, the US markets, and you can see these are the major indices. NASDAQ just a little bit down here, Dow Jones flat, and S&P flat as well. If I come onto the 5-minute chart here, you can see it's just calling off here. The traders are just calling off on both Bitcoin and the S&P leading up to this meeting. Another 8 minutes to go, so 2 more of these candles before that meeting. Just to zoom out again, remember on the hourly chart, you can now see that the bears are fighting here on this specific candle. If I show you here, remember this was a nice big green candle on the hourly, but look how the bears have come in later on. If I show you this on the 5-minute, you'll see what I mean. There you go. There's a nice big move to the upside, to the top side of the channel. And then in the last few set of 5-minute candles here, more redness coming into the market. So just staying within the range, right? Bitcoin staying within the range. It's not going to dare to come out of the range until we've had some data. It tried to a few times. They were just fake outs to the top side and to the bottom side just due to volatility. But otherwise, all week, you guys could have traded this nice and comfortably up and down and captured the move here in the middle. So yeah, let's see what else Bloomberg are saying. Still Gary Gensler.
Companies may need to leave the U.S. markets.
Gary Gensler, thank you so much for joining us on this historic day. Greatly, greatly appreciate it. And
thank you,
and good luck with the rest of your day. Thank you, Gary. Greatly appreciate that. And joining us now, Jason Furman, who has stole the dialogue of the last few days with incredibly important comments on some of the legislation and decisions.
Guys, let me know if you can't hear that okay. Hopefully the volume's okay there for you guys to hear that. Few other things. What am I doing in this market very quickly before we go into this? I've got a few limit orders set, okay? So like I said to you in this morning's video, if you didn't watch this morning's video, I've got limit orders set in case Jerome Powell freaks the market out. If the Jerome Powell freaks the market out and hits below 20, I'm going to buy some below 20. And then 19, I've got a limit order, which is more than the limit order at 20. And I've got a limit order at here at 18,700. Sorry, I put it at 20, 19. And I've put one at 18,700 as well with a bit more. So the nibbles get a little bit bigger at each of these key levels, okay? Just for my DCA bag, just so I've got some more Bitcoin and Ethereum. So those are the limit orders I've set. And let's see how we crack on here. Now, if we rally to the upside, it's calm. I'm not going to chase. I don't need to chase it. I'm good. I'll just be happy that we run to the upside, and we'll have to reevaluate. Can we hold above 22? Can we get a move up to 24? Then we need to see, okay, what's going to happen there. But let's see what data we get. That's going to be the important thing going up. Floating high says, no need for limit orders, mate. We're going up. Hopefully. I don't mind. If we go up, absolutely no problem. Like I said, mainly in the market. I just love to take the opportunity when people freak out to buy a little bit more. So if we're going up, good for me, guys. I don't mind at all. I'm cheering for some good news, cheering for some move to the upside. Paul, appreciate you supporting the channel. Barney, is it me or does Gary look like Mr. Burns? Classic. Definitely looks like Mr. Burns. Nicely done. Cool. 6 minutes to go. Do you guys have any questions before that? Anything you're worried about leading up to this meeting? Anything you're not sure about? Floating High says, we're going to 30K and we'll take Jerome with us. Well, we're not going unless Jerome Powell lets us go. So it's the other way around, right? Jerome Powell's got to let us go. If he comes out, that's what I mean. The market's not standing on its own two shoes. Sometimes it does do that when it gets frustrated with the Fed. But right now, it's just waiting for permission from the Fed. It's like, oh, can I please go to the toilet, sir? Like, it's like unbelievable stuff. Ian, good to see you on the live. Andy, excellent. Good to see you. Guys, please do smash up the like button. Really appreciate it. Can we get to 100 likes? There's over 144 of you in here. Please will take a second to smash up the like button. It doesn't cost you anything. And if this stream deteriorates from here on in, you actually can get a refund. You can just press it again. The like button disappears. And nobody was none the wiser that you unliked it. So yeah, do give me a like in advance. Then if I don't earn it, you can always undo it, I guess, at the end of the video. Should I be prepared to sell short or buy long? So I just told you what I'm doing in the market, guys. It's up to you what you're doing. Nothing's going to cause me to sell my Bitcoin. Absolutely not. I'm looking to add some more if we get a dip to the downside. If we run to the upside, I'm going to cheer and clap and enjoy because it finally means we can get back out of this channel. I don't like this channel at all. This channel we're in between the two green lines, you guys know I'm scared of this channel. And the reason I'm scared of this channel is a breakdown from 18,700 at the bottom of the channel gets really, really scary. So this looks good right now, right? If we could get a positive day and start working our way this direction, this won't look too bad. It'll just look like we dipped in and came back out. That's a good narrative. But if we start doing this and then go challenge at 20 and lose 20 and start doing this, oh, then it gets really, really nasty because then you can see what that pattern is, right? That pattern's not a great pattern here to the downside. Now, few things here on the 4 hourly from a technical perspective, even though technicals really don't matter right now. I'll be the first to tell you that, guys. We're running into our 4 hourly EMA ribbon, okay? So you do have your EMA ribbon giving us resistance at this level, but it doesn't matter. If Jerome Powell gives us some good news, we'll flip our EMA and we can start working our way to the upside here. Guys, 4 minutes to go before Jerome Powell. We'll switch over shortly. Nelson says, everybody like the video. Yes, please, guys. Amazing. Since I asked you guys, you got it to 95 likes. Just 5 more of you. Please hit up the like button. Ian says, I think it's going to be ugly. Tobias says, can I show the SP? Yes, we've got the S&P here as well. We can see the S&P. We've got both of them together. We'll keep it like that. Somebody's asking about DOT. We're not looking at Polkadot right now. Try catch me in the Discord or something. I'm more than happy to look at Polkadot for you. Just want to focus right now. BGM Music says, my like button area is broken. He smashed the like button too hard. Stu says, lots of videos coming out right now in China and impending real estate. Yeah, I guess it's just an easy topic to make videos on, right? I mean, yes, it is a concern. I think something we'll have to keep an eye on, but I don't think we've seen, massive progression towards that. Oh, incidentally, as we're talking, 5-minute green candle here. Again, 4 minutes now before, how many minutes we got left? 2 minutes, sorry, to go. Let's switch over to Bloomberg so we don't miss anything, guys. Let's get over to Bloomberg.
10063 on euro dollar. Of course, the theme today has not been the theme of the year so far for foreign exchange.
And this isn't driven by the euro kind of strength. This is driven by perhaps a little softening in the dollar on the heels of some of that economic data. It's not exactly something that's coming from this feeling the ECB is going to hike it and get some
no big moves in the bond market off the back of that data this morning. Just PCE coming in a little bit softer for July, in line with what we saw for CPI as well. Yields on a 10-year up about a basis point to 3.037%. On a 2-year yield, basically unchanged at about 3.36. We've talked about how close we've come to 3.40 through much of this week. 3.45, the high of the year. Steve Major, you mentioned Steve. He thinks, like many of our guests thinks, for the 10-year, we've seen it. We've had the high. 3.0371% on the 10-year right now. Mike McKee, pop it into the seat. Mike, the chairman, about a minute away.
Yes, and it's going to be a big moment for everybody on Wall Street who wants to know how tough he will be, what is the strength of his message, not so much what is his message, but how strong and forceful is he going to be about trying to bring down inflation.
What happened to the walk? The walk, is that afterwards now?
I think it's going to be afterwards. Maybe it's a little too cold. They saw you guys shivering out here and decided we're not going to do that.
Thank you, Tom.
How much are the presidents? One of the great shocks here, folks, at Jackson Hole. For those of you on radio, it's a beautiful lodge, beautiful windows, and all of a sudden, all the bodies that we look at discreetly are all.
Just over a minute away, guys. Hopefully they switch across to Jerome Powell soon. It does say Fed Chair Powell to speak momentarily. Again, we're looking. Does he speak hawkish? Does he speak dovish? This is what we want to hear, right? That's what we need, is direction around what's he going to do with interest rates. And then if we can get that news, equity markets can feel confident, and then Bitcoin can feel confident. He gives us bad news, equity markets will not feel confident. They'll go risk off again, and more downside, more opportunity for us to buy the dip on Bitcoin. Either way, I've got myself to a mental position where I'm happy with either, right? So let's see, 3 o'clock, let's see if they switch over.
Expect to hear more from that with Fed Chair Jay Powell, given that that's sort of the feeling right now.
That's going to be one of the key questions we'll know in just a few moments.
We're going to hear from the chairman of the Federal Reserve. Let's listen in.
Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
He means business, guys. Markets won't like this.
We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
Telling the markets off, guys. He's being strict. Strict Papa.
At our most
Powell.
recent meeting in July, the FOMC raised the target range for the federal funds
We'll get
rate
some dip opportunities.
to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases.
At some point, not now.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Okay.
Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
The Chairman of the Federal Reserve,
Not taking any questions,
Jackson Hole, Wyoming, with a pretty strong message.
Huge. We'll come on to their reaction, guys. I want to listen to what they say. But in essence, Jerome Powell came out as we expected last night on that video I did on my phone. And I said he's going to mean business. He's going to come out. He's going to put his foot on the throats of the markets. And he's going to say, I'm going to continue. So in other words, he's saying, I'm going to continue to do what it takes. I want to see inflation come down. So for me, I think that means at least another 75 basis points in the next meeting. And he's going to keep his foot firmly on the throat of markets. So that prevents any rally we could be seeing here in the near term. You can see the markets are notching down here, S&P falling here. But the bleeding isn't huge. I think the market's going to take a little bit of time to digest this data. You know what this is like, guys. This is traders just playing their games, but long-term people who move their capital are going to think about that over the next coming days and Monday, Tuesday next week. So lots going on, guys. He spoke about Volcker. We'll do a summary video later on as well for you guys so you can get all the headlines from that if you weren't paying attention. I know it's easy to switch off when Jerome Powell is speaking. Let's see what the reaction at Bloomberg
We need to not loosen too quickly. We're not going to cut rates so quickly. That's basically what he's trying to say. And he's trying to send a hawkish message, which was heard by the front end. Now the question is, the pain that he's talking about, do people think that we're still going to get that soft landing? Is that what's being reflected in the bounce back of the stocks that we're seeing?
How many times have we heard this Fed chair talk about the strength of the underlying economy? Tom, we
I told you he was going to use that.
It was there, and it'll be with the data that we see out here in the coming days. And frankly, we saw it with the good disinflation data today. I found it interesting, not only the brevity of the speech, but to the point of he and the people advising him, boy, was it structured. A first lesson, a second lesson, a third lesson. Only Mike McKee knows the fourth lesson.
Well, Mike McKee, there was a moment at the very start of that speech.
Interesting. The market hasn't moved quickly to put price in 75 basis points just yet. They're still sticking to their 50-50 kind of balance here.
Later this year.
I think what he's speaking in Fed euphemisms, of course, because he can't say recession, and he's not going to say we're going to throw a lot of people out of work. But he's basically making the point that we are okay with that, and we expect that to happen. We're going to see some people lose their jobs. Inflation is going to come down, but we're going to keep at it until it does, and that will cause pain in the economy. And I think the whole idea here was to sort of take Wall Street by the throat and shake them and say, we've been saying this all along, but specifically A, B, C, get the message. This is where we are.
Jim Bullard, in your chair moments ago, iconic for regime change, a different way of thinking. Is this a chairman with his brief speech today signaling theoretical or process regime change at the Fed?
No, I think he's just saying this is where we are now. This is where we have to go. And so between here and there, there's going to be higher interest rates. There's going to be pain. After that, when they bring inflation down, that's a question for later on, which is pretty much what Jim was telling us. You got to get through the current situation first. And the problem that the Fed has faced is that the market has been fighting them. And now he seems to have slapped them upside the head, as they would say out here, and hopefully got their attention.
Hold on a second. He slapped up the up on the side of the head, or whatever you just said, and yet we're not really seeing the reaction. Almost all of the losses are almost retraced, and we're down about 1/10% now. So talk about how if they're perhaps not getting the message, or are they, right? Is this the message that they want to see? Are people basically not buying that the Fed is going to allow this kind?
Even the Fed rate monitor tool, it's not moving. This is not moving. The SPY's not massively. I mean, it had the dump where the traders dumped, but we're holding steady for now, which is pretty interesting. Are they delaying it? Could there be a delay, or are they just going to say, you know what, fine, we'll crack on. We're not going to rally off of it, but we're just going to stay sideways. There's not much more we can retrace. We've retraced enough. That's kind of my feeling right now, is are we just going to stay around these levels for a little while?
The market is saying we want to see proof, not just words. And you're going to have people who are going to test the Fed on this. And there's nothing that Powell and the committee can do right now to prove. It's just going to take time. And so at this point, the market's going to argue about this, but I don't think you're going to see them run away in the direction that they were going before.
To your point,
with equities
Mike, the proof is going to come at that very moment when the dual mandate's in conflict and they're still hiking interest rates.
And he made it clear where they're going to go when that happens.
And I don't think many people buy that, because what happens when...
By the way, guys, if you appreciate us covering this kind of stuff here on a Friday, make sure you smash the like button. Don't forget to subscribe, guys. This is the kind of content I want to deliver on this channel. The whole reason I started this YouTube channel was to give you guys the real content. I come from a traditional finance background. I understand the macros. I understand the fundamentals. I've learned technicals. But loads of people are just coming into crypto and just doing basic technicals, or following these moon boys on YouTube who are just showing them a random chart pattern on their mobile and saying, oh, trade that pattern with leverage. No, you've got to understand all these nuances. So if you appreciate that, guys, smash the like. Don't forget to subscribe. I will be here with you when these key pieces of data come out, and I'll be breaking them down for you so we all understand it together and we know what moves we're making together as well, guys. 200 of you in here. Please do smash up the like so we can get some more likes on the stream. And let's see some more reaction from here.
Powell
we'll go
says
to the charts
you
after.
can't go backwards. You know, you can't. You have to keep at it, and that's the message that they want to deliver. That we're going to go through this. We're going to bring inflation down. There'll be a cost to that, but we're not going to change our minds.
When in doubt, look at the footnotes. And there was the academic moment with Sims and Benjamin Friedman, who was one of my first interviews at Bloomberg. He is the giant of how nations think about growth. Can they pull this off with recession-like growth, whether it's a growthy recession, NBER recession, whatever America's feeling now? Can they pull off all this happy talk given tepid growth?
Well, that's the remains to be seen part. That's the part that Wall Street is challenging, and that's the part that Powell tried to push back against today. And he talked about a period of under trend growth, low, slow growth. Right. So he's not. He can't come out because of his position and say, yeah, recession's likely, because then the markets would tank. But he can sort of hint that this could happen, and we're still going to push through it.
Oh, Michael McKee, thank you so much. Just great coverage today. John, is this the most controversial market economist in America today?
Who's that?
Introduce right
Mike
now?
McKee or Chairman Powell?
No, not President McKee. Let's bring in Anna Wong. She is Bloomberg Economics, and she has set the world afire with an exceptionally aggressive outlook for inflation. Anna, let me begin with the simple question. If we get an Anna Wong interest rate regime, what happens to American economic growth?
As Powell said, what's important, what's the bedrock of American growth is price stability. And if you do need a
question from Ian Ijaz. What do you think of the Volcker comments? Do you think that that means he might take the Volcker model and go real hard for a short time? I think so. What he was saying was that Volcker tried many times, right? As in not Volcker himself, but at that point, inflation was so entrenched that they tried many efforts for 15 years and couldn't get inflation down. But by the time Volcker came in, he had to be aggressive and for long. What he's almost saying is, I want to be aggressive now and take this opportunity to make sure this cigar is really put out, instead of leaving that little flame there, which could then grow back into longer term inflationary pressure over decades, right? So that's what he wants to avoid. I think what he's trying to say is, look, while I've got the opportunity, I don't want this to get out of control on my watch. I'd rather take the short-term pain of a little bit of a deeper recession, more unemployment, people losing jobs, in order to just make sure inflation is done once and for all whilst we've got momentum. So I think he's happy to see the July reading. He said it's welcome, but he wants more progress. And I think he made that clear, to be fair, even before the July meeting, which is why I was so confident he was going to be hawkish today. Is I think he would have sat there in July when markets started rallying saying, hang on, I must have got my messaging wrong, because they're thinking I'm dovish and they're going on a little bit of a summer rally, whereas I'm not done yet. I'm just getting started. I need to really bring inflation down. So I think it's a bit of a reality check here today for the markets, and maybe they won't react today, but definitely by early next week, I think the market might start to absorb that and understand that, look, it's not easy. It's not a free ride here that we're just going to suddenly go for a summer rally. I think they're going to have to really evaluate what they're hoping for.
Likely to ease in 2023. But I think my assessment is that the speech we just heard is, if I have to rate it in the scale of 0 to 10, 10 being most hawkish, it's around 6. I think the lessons that Powell explained from the 70s, the first lesson, he said that, monetary policy alone can bring down inflation. Everybody agreed that lesson likely won't be repeated. But I think the lesson that could be repeated, and he did not talk about this really, is that Arthur Burns did raise nominal interest rate well into a recession. In fact, generated one of the deepest recession that the U.S. has ever seen back in 1974. So he did not say that the Fed would be ready to, hike well into a recession.
Right.
And yeah, so I think that's a mistake that is.
I'm seeing a significant market reaction right now, John. We have a 2-year yield which has moved out to a new high, and I think it's profoundly significant. I don't think it's a small matter.
It's up around 5 basis points at 341. I don't happen to think these moves are massively dramatic off the back of the speech.
The market move isn't there, but the 2-year speaks volumes.
But I do think the emphasis of this Fed chair is important, or perceived emphasis of this Fed chair. In the news conference at the last Fed meeting, there was this feeling that he kept talking about neutral, which implied to some people that maybe they were almost done.
Right.
And I think what this speech has done is almost correct that address in that news conference. Mike, do you get the same feeling on that front?
If there was one line in here that I wondered about, was he repeated the idea that at some point monetary policy changes will slow down. I think that was one of the lines that was misinterpreted by Wall Street the first time he said it, and I was surprised he included it again, because if you're looking to make the case that the Fed is going to be too easy, that's one of the things you can use as your proof. He means we aren't going to do 75 forever, but the markets could take that differently, and I don't think that's the impression he wants to leave.
Anna, dare I say, do you think that this was somewhat of a cleanup act for the last news conference?
Yes, I think so.
Yeah, I definitely think so. He did say that, even with a soft July print, he thinks that the labor market is still strong, so underlying momentum is actually strong. And he did hinted that the neutral rate, the short-term neutral rate, could be higher. So I'm expecting, and I think he's previewing that in the September FOMC, we might be seeing that the R-star could be revised higher.
Anna, great to catch up with you. Anna Wong there of Bloomberg Economics on her ideas of what we've just got from Chairman Powell just moments ago. Tom.
I think we need to reframe here very importantly before Ira Jersey, John, the interest rate debate. Help me here with the names, Lisa, as well. There's a group with a lower regime, Kovanovic at JP Morgan, clearly there, but there's other names saying what? 3.5, 3 3/4.
I think we've got a perfect guest in about 10 minutes' time. As we catch up with Andrew Hollenhorst in just a moment, Tom,
and he's higher.
Over at Citi.
He's
at 4% year end.
Yeah.
And Anna Wong is way up here with a select group. Dudley, I would put up there, maybe not quite as high as her, but there's a real dispersion.
Let's take Chairman Powell's comments as a given, that we've got a really strong underlying economy. What does that imply? That if you want to get demand down, let's take Mike McKee's interview with Esther George earlier this week. If you want to get demand down, you need to get rates up. And if you believe that the underlying economy is robust and strong, then clearly they've got a lot of work to do.
But Lisa, where's the given on a strong underlying economy for X% of America that's flat on their real wage, negative real wage back?
Raphael Bostic said something that's a little concerning.
Okay, guys, let's park that there. Let's take a quick look at the charts. What are we seeing here in this channel still, guys? I think the market's not overreacted to this. I don't think it's kind of dumped out. You had a big wick down to the bottom of the channel, and then the bulls came back in here later on in this hourly candle. So looking okay for now. Again, this is more of a long-term kind of thing. The traders would have done their thing right now. They would have used the volatility to enter and exit their trades. I remember that from my TradFi days. But for now, the focus is going to switch to the long-term portfolios. And now I think what Jerome Powell's done is kind of put a foot on any meaningful rally. That's my early thoughts right now. He's probably put a little bit of a wrench in the works of any meaningful rally between now and the next meeting. I think the next meeting now we can all but say it looks like 75 basis points, although the market's still 50-50. They're not sure. They think he can still U-turn. Remember, before September the 21st, on the 13th of September, okay, so just over 2 weeks and a bit to 2.5 weeks from now, we will get our next CPI reading, okay? So that's going to be the August CPI reading going into the next FOMC meetings. That's something we'll have to look out for, extra piece of data, because by then, if he's got 2 CPI datas coming down and it's really inflecting down, then we can start to say, okay, we're getting more and more evidence. But I think even if that CPI comes down, I have a feeling that Jerome Powell is going to continue to be aggressive, at least with another 75 basis points. I feel like that's what he's going to do. Let's not forget, guys, the data we're looking at, the inflation data, including the PCE which just came out, this is data from the previous month, right? It's a lag measure. So it's not August data, it's July data we're looking at. So August, we already know crude oil went up. We know there was issues with Saudi Arabia restricting supply and OPEC. So these things could link back to inflation getting out of control again. So Jerome Powell doesn't want to be reckless and say, oh, I saw one reading, therefore I can start reducing interest rates. So that's something to watch out for. Again, what am I going to do in the market? I'm going to sit tight. I'm chilling. I want to see which direction do we get on this wedge. We might stay in it for a little bit longer. I think it'll need to make a decision at 22. I don't think we're just going to keep doing this all the way through 22 gradually. I don't think so. I think at some point it's going to make a choice. So do we want to go fill this gap up towards this kind of level at 23, or do we want to start falling and going testing 20? It's going to be one of those situations. I think the 21 is more likely, but it depends how markets want to digest that data. Remember, we do still have good PCE data. We had good CPI data. So the markets, should feel good. But let's see how that progresses. Okay. Cool. So I think we'll park that there. I'll do a summary video for you guys later on for those of you who missed this. I'll do a summary video explaining exactly what went on, what Jerome Powell said. Guys, make sure you stay strong out there, right? Don't panic sell. If the market suddenly wicks down to 20 when I'm not on a live stream, see the course, understand why you bought, make sure you're building your conviction, do the basics right in this crypto winter. And look, if we're in this winter, if we're in this kind of a range for 6 months, 12 months, this is your opportunity to go and accumulate. This is your opportunity to go figure out your streams of income and figure out how can I accumulate in my high conviction plays, right? This is the opportunity, because trust me, when the market starts running, you're just going to wish you had more. Trust me, you're going to wish you had more. Take it from someone who's been for a few bull runs before. You're going to wish you bought more. Right? Trust me. And so even when Bitcoin gets to 30,000, it's going to feel far more expensive than now, right? Because it will be. That's another 50% more expensive. So each element you're able to put into the market now really does pay off dividends. And that's my focus right now, is if the longer we're in this range, that's more opportunity we have to accumulate. And that is a great news for us, so we can figure out our cash flow and get it into the markets. If we run to the upside, fine, but I'm still going to wish I had more. Hope you guys enjoyed this live stream with Jerome Powell. Jerome Powell firmly putting his foot down on the markets, not letting us have any. I mean, he's really angry that we had our relief rally, and he came out with vengeance. You saw from how he started speaking right at the outset, he meant business. He wanted to put us back in our box, and he said, don't you dare rally. I still mean business. I'm going to increase interest rates going into a recession, and I mean business. Guys, don't forget to smash the like button and subscribe. Go watch another video on the channel, and I'll see you in the next one.